Hey y'all, Ryan from TrendLizard.com here. Happy New Year. We made it. We got through this crazy year, 2020. Congratulations. Obviously, a very unique year in terms of the world, the pandemic, the economy, and for our purposes, the stock market. I think a lot of people will tell you, hey, thank goodness 2020 is over. But from a stock market perspective, I'm not sure if that's going to be the case. And that's what I want to take a look at today. I want to take a detailed look at what happened in 2020, the huge crash early in 2020, followed by one of the biggest, most direct bull markets we've seen in the stock market history. And then see what that means for the stock market as we head into 2021 and what we might expect from overall market direction, because honestly, that's all that really matters for stocks. If you're new to investing or new to Elliott Wave or any of that stuff, you're going to find that most stocks move in the direction of the stock market. So the most valuable piece of information we can know is what is the overall stock market doing, and that's what I seek to provide for you today. When we're done with our recap and our forecast of 2021, I want to provide a list of stocks that I think are going to outperform moving forward based on their Elliott Wave patterns, and we'll see where they go. So we're going to take a look at several charts. So get comfortable. Let's dive in and see what the market has to tell us. Here we go. Okay, folks, so the first thing I want to do is provide a very quick Elliott Wave tutorial just to set a basis or a kind of a foundation for what we're going to take a look at for those who aren't super inept in the process of Elliott Wave. And so I'll make it quick and show you exactly the most important tenets of the Elliott Wave theory. And that is when you're looking at a price chart and looking at a trend, we expect trends to play out in 5 wave moves. An up move, number one, a down move that retraces a portion of that first up move, another up move, wave 3, a 4th wave pullback, and then a 5th wave up move. So this thing here represents a 5 wave move. When we see the completion of a 5 wave move like this, we have to expect a reversal in the market trend and a correction of this 5 wave advance. How big would that correction be? Generally, you expect it to last about 50% to 100% the amount of time that this move took, and you expect it to retrace about 38.2% to 61.8% of the distance that this move traveled, and that's a Fibonacci retracement is what we call that. So this is the basic tenet. This is basically the most important thing about the Elliott Wave theory, and it's important to get that kind of footing underneath you and to show you why our forecast is what it is as we look at what's happened in 2020 and what we can expect for 2021. So to start, I want to show you a few real-life examples of this pattern here playing out to show you how it works. First up is Apple. Here's the advance off of March's low. It gave us a 1, 2, 3, 4, 5 wave move. Once that 5 wave move completed in September, it has traded largely sideways since then. Obviously, it's been down, up, and all around. But as you can see, the completion of the 5 wave move changed the trend and turned Apple sideways. Here's a look at Mastercard. It gave us a 5 wave move to the upside off of March's low, and then it gave us a pullback. We expect these counter trend pullbacks to take an ABC or a 3 wave move. And then the yellow area that you see here represents a 38.2% to a 61.8% retracement. So it retraced that amount. Now it's turning higher again. But again, the point is it completed a 5 wave move and it changed direction. Here's a look at an ETF that we follow every day at TrendLizard.com. This is the Russia ETF, the most popular one, RSX. Same thing, completion of a 5 wave move, and then you get that 3 wave pullback into that Fibonacci retracement zone. Next up is SPLAK, Splunk. Again, the completion of a 5 wave move. Once it did that in September, a larger 3 wave pullback has started, and it's found support so far in that yellow Fibonacci retracement area. Here's another one. This is Vale. This is I believe a steel company from Brazil, and you get a nice 1, 2, 3, 4, 5 wave move. Once it completes, you get that larger pullback into the yellow support area. This one undershot it a little bit, but once you get that retracement, price turns higher. So over and over again, you can see these examples of what happens when a 5 wave move completes. Price stops, reverses the trend, corrects that 5 wave move before it continues to the upside. Here's one you guys might know. This is Google. Again, a 1, 2, 3, 4, 5 wave move. Gave it a 5 wave move into December's high, and it's been pulling back since then, likely to continue a little bit lower to find support in that yellow area. So the question may be, when you're looking at these 5 wave moves, how do you know when the first wave completes? How do you know when the second wave completes? Things like that. The trick is that you're looking for the completion of a smaller 5 wave move for wave 1 And always the moves that happen in the direction of the trend are supposed to play out in 5-wave moves. So for example, if we take a look at just this first wave advance here, you can see that it's taken a 5-wave move. If we zoom in on it, you can see that 5-wave move. If you zoom in on just the first wave of that smaller 5-wave move, again, you see a 5-wave move. This is the fractal nature of the Elliott wave pattern. 5-wave moves happen in the direction of the trend on all time frames, no matter how far you zoom in. If you wanted to look just at this first wave here, the theory says it'll play out in a 5-wave move. That's how you find the direction of trends. Which direction are the 5-wave moves playing out? Those are counteracted by 3-wave moves, and which are counter trend moves. Those happen against the trend. But I think that should set the basis for why we think things are going to change in 2021, and I'll show you why. First, let's take a look. This whole thing is going to largely be based off of the S&P 500. This is where we were heading into 2020. This is at the very end of 2019. We were in this large, trendy bull market, massive bull market off the 2009 low, in a large 5-wave move that's been playing out. When this 5-wave move completes, as we just looked at, price reverses, that 5-wave move is corrected. Doesn't matter what time frame you're on. If you look at the advance in 2009, it completed a 5-wave move, price reversed and corrected it. This is just how it works. It just depends on what time frame you're talking about. Right now, we look to be talking about a pretty large time frame. So here is the same move on the Nasdaq. As you can see, we're very late in a very long-term bull market, biggest bull market time-wise and distance-wise in the history of the stock market. So it's a big move. So obviously, things did not continue up in 2020. Here's what we were looking at. If you look at it from kind of a midterm time frame, we had this third wave and what appeared to be a fourth wave pullback in 2018, and then price broke out in 2019. It wasn't clear if this was the end of a fourth wave pullback here, and this was a fifth wave advance here. But as you know, early in 2020, price reversed, absolutely tanked. The S&P 500 lost 35%. Over the course of like 6 weeks or something. It was a very quick move. In fact, the fastest bear market in the history of the stock market, and a lot of firsts in the history of the stock market taking place here, but a 35% decline. What we found with this decline is that it left this advance to a new high as a 3-wave move. That's not a trendy move. We know trendy moves play out in 5 waves, so the fact that this was a 3-wave move told us that it was all part of a larger 4th wave pullback off that 2018 high. So you have a 3-wave move for wave A, you have a 3-wave move for wave B, and a super sharp 5-wave decline for wave C. So all of this proved to be the 4th wave of that massive advance that began in 2009. If we play it forward after that low, obviously prices turned higher and been very bullish since then, setting a new all-time high in December 2 days ago on Friday, I guess before the holiday on Thursday. But obviously, price turned higher. It was a huge move. If you look at action off of the 2020, or just in 2020 in general, it was a 16% gain for the S&P 500, but a 71% rise off of March's low. So you had a 35% drop, and then this massive recovery move that's moved to new all-time highs as it's progressed. So that's been a very bullish thing. If we try to label that move, this is what we come up with. At no point has this move corrected. It's gone straight from March's low into December's high. It's been a straight line move. It appears to be later in the formation of a 5-wave move. So if we remember, when 5-wave moves complete, that's when price reverses. So we need to be on our tail or on our toes here, because overall in the 2009 advance, you have a 5-wave move. This appears to be the 5th wave of that move. And then in the 2020 advance itself, you can see the potential that a 5-wave move is completing to the upside. Same chart. Now, it's possible that wave 5 is going to get a lot bigger before it's over. We had a strong up move in early November, and it's been choppy since then. It's possible that we're just seeing the first and second wave of a larger 5-wave move for wave 5. So I'm not saying that we have this imminent reversal here. It may get bigger, and until we see some type of sign of reversal, you can't touch this thing. You have to expect higher prices. You have to remain bullish. But what we're seeing from the facts of the price action is that we could be getting very close to a more important high. Now, if at any point the S&P 500 moves below 3425, that's going to be an indication that this 5-wave advance completed, and could potentially mean that the entire advance off the 2009 low has completed. So a move below 34.25 has to be seen as a bearish indication. Remain bullish until you see that, but if you get a move below 34.25, we have to expect a larger pullback, at least a correction of the 2020 advance, if not a correction of the entire 2009 advance. So obviously the stakes are high. Now, the reason that we believe that we're still in the advance off of March's low is if we look around the market. This here is a chart of EPI. It's one of the ETFs we track at TrendLizard.com. It looks at India, and you can see that this is clearly still the same advance off of March's low. It's a super overextended move. It looks to be in the fifth wave. It's not over yet. It's been super strong. You never exit a move this strong until there's a reason to. But as is, you can see that it looks like it's getting late in the game, and we have to be careful. So that's something to be aware of. So let's go ahead and zoom back out and see how this fits in the long-term context. Again, this is the advance off that 2009 low. You have a first, a second, a third, and a fourth wave. So 2020, what's it been about? It's been about completing a large fourth wave pullback and kicking off a large fifth wave advance to the upside. If we look at the same thing on the Nasdaq, again, first, second, third, fourth wave, 2020 has been about completing that fourth wave to the downside and then giving us a massive fifth wave advance. And if you look at the returns on the Nasdaq in 2020, it is incredible. Considering that it lost 30% off the high, it still returned 44% on the year. And if you looked at the advance off of March's low, it's a 94% return in 9 months. It's been an absolutely massive move. A lot of people have kind of learned to trade in the stock market in 2020, and they think this is normal. This is not normal. This is insane. This is crazy how big it's moving. Doesn't mean it has to end immediately. The market can remain irrational for a very long amount of time. We know that for a fact. But it's irrational. Make no mistake about that. This thing is crazy. And I'll show you exactly why we think it's irrational from some of the actual technical indicators, aside from the fact that it's been a 94% gain in the midst of a pandemic when the economy has been shut down. It's kind of hard to reconcile all of that, and I have an indicator to show you exactly how disconnected the market has become. But with this in mind, look, we feel like we're getting closer to the end of the 2009 bull market advance. It's now been in play for 11 years or so. If a high was to occur today, or say on Monday when it opens, we would be looking for a retracement down into this area. You're talking about 5,700 up to 8,500 on the Nasdaq. That would represent a Fibonacci retracement of this entire up leg. If we go back to the S&P 500, same thing. If a high was in now, that retracement would be about 1,900 to 2,600. So you're talking about a very big pullback. So timing-wise, hard to say. Once Wave 5 completes, when you see a change in the market's behavior and if it shows any significant weakness, you have to be on your toes that we have put in a long-term high and a much larger pullback is happening. Don't worry about it until you see the weakness occur, because again, the market can remain irrational for a very long amount of time, but if things start to reverse, we're going to take it seriously. So let's look at a few of the indicators that back this up. First, I want to take a look at what happened the last time we saw a completed five-wave move on a long-term time frame. This was back in the 90s, first, second, third, fourth, fifth wave. What happened? We embarked on a massive counter-trend, decade-long ABC pullback. That was obviously the 2000 high. I'm not saying this is exactly what's going to happen again. I'm just saying what happens when you complete a long-term five-wave advance is you get a major pullback. So if we're completing a long-term five-wave advance, we need to be aware that a major pullback is going to occur when you complete an 11-year move. It's going to take a significant amount of time to correct that move. So that's what we're looking at there. Here's another indicator. This is the monthly reading on the put-to-call ratio, right? This looks at the number of puts that are bought relative to the number of calls. So when it goes to a very low level, it means more and more people are buying calls, fewer and fewer people are buying puts. It means there's a consensus and that you have a majority. Generally speaking, the market doesn't like the majority to be right. So in November of 2020, this indicator set an all-time low. I think it was at 0.43 right here. Generally speaking, that's a bearish thing. You see we got a similar low reading right before the financial crisis in 2007, 2008. Concerning. So that's one indicator. Let's move on. Here's another indicator here. Doesn't all fit onto my chart. If I scroll down here, we see at the lower part here, this is the Aai Sentiment Survey that happens, and it looks at the number of bulls out there, the number of financial advisors that are bulls versus the number that are bears. Okay, so the last 2 times that this indicator had a plus 30 reading, which means there were 30% more bulls than bears, it happened in 2018. Zoom up a little bit here, and late 2014. The last time it happened in early 2018, it led to a sideways market for an entire year. The time before that, when it happened in late 2014, you had a sideways market for over a year, probably a year and a half. So a pretty substantial amount of time. We moved above 30 for the first time, I believe, in November recently. Got to wonder if we're not getting closer to some type of larger pullback. Moving on. Now, this indicator here, the black line shows the S&P 500. The red line shows if the S&P 500 was valued at a PE ratio of 20. Purple shows 15, which they consider fair value. Green shows a PE of 10, which would be undervalued. So red is overvalued, right? This is kind of where the market generally hangs out. We can kind of expect that the market runs hot. Here's what's happened currently. The PE ratio, a 20 PE ratio is way down here. The actual price of the S&P 500 is way up here. You can see from the history dating back to 1980, this is by far the biggest disconnect that's happened between price and the actual earnings or the value of the S&P 500. This is a massive disconnect. Doesn't mean it's going to change right away. It just means there's a massive disconnect, and it's worth noting, especially when it appears that we're in the 5th wave advance of the longest bull market in stock market history. So let's move on. This is a different one here. This red line here shows the number of stocks that are trading above their 200-day moving average, right? So when you see a very large number of percentage of stocks that are trading above their 200-day moving average, it means the market's overextended. Back in 2003, we saw this indicator move above 90. Back in late 2009, we saw this indicator move above 90 as well. We are right there for the first time in over a decade of the percent of stocks that are trading above their 200-day moving average. So if we scroll down and we look at some of these gray lines, which represent the highs in the past, you can see that these spikes that have happened in the number of stocks trading above their 200-day moving average tend to occur near larger pullbacks. Doesn't mean major, bull market high type pullbacks, but they tend to happen around pretty important highs. I don't know if this time's different. I think we're probably going to see more of the same. So I think that's something worth paying attention to. So one more chart. This is more seasonal. This takes a look at what's happened at the turn of the year over the past 10 years or so. Back in 2012, 2013, 2014, January 1st really meant very little. The uptrend continued. Since then, since 2015, right around the start of the year in 2015, the uptrend turned sideways. In 2016, the sideways trend turned down before it turned back up. There was a continuation year where the uptrend continued, but in 2018, the uptrend turned sideways. In 2019, that sideways trend turned up, and in 2020, the uptrend turned down. So there's been a tendency over the last 5 out of the last 6 years for the market to change direction close to the start of the year. I'm not saying it's going to happen again. I'm just saying it's a tendency that is worth paying attention to, again, especially since it looks like we could be getting closer to a high on multiple time frames in the 2020 advance, and again, the overall long-term advance off the 2009 low. I want to make it clear, I'm not advising that you sell everything and get out of the way. This is an exceptionally strong market. It's hard for the market to pull back even for a full day. If we see a little bit of a weakness on an intraday basis, it looks like it gets bought up right away. There is no way I am selling until I see a change in that behavior. But the interesting thing about that is when we see that change in behavior, it's going to be notable because this market has been so one-sided. So when you see that weakness, I think you have to respect it. So as far as 2021 is concerned, we're bullish going into it. But the second we see a crack in the dam and we start seeing things leak, we're going to be concerned because it could mark a high to the long-term advance off the 2009 low. So that is the forecast. Now, I want to take a look at some 2021 stock ideas for you. Things you might want to put on your radar, things you might want to invest in as we go in 2021. We're going to start here with Apple. We took a look at this before. Here's what makes it bullish, okay? Off of March's low, you had a trendy 5-wave advance. The fact that we're getting 5-wave advances to the upside is bullish. It means the trend is up. Now, since then, we've had the pullback in September and basically this slow, choppy grind to the upside. Now, I can't guarantee that we're going to get a larger pullback here, but that's what it looks like. But that's not the important thing. The important thing is that this pullback off of September's high is a counter trend move. So you can get a larger ABC pullback back down into the yellow Fibonacci support area. But once you get that, if you get a move back towards September's low, this is going to look like an incredible buying opportunity because this is what we're looking for. We're looking for 5-wave advances followed by 3-wave pullbacks. That dictates that the trend is still up, and it gives us an opportunity to buy something as a new 5-wave advance begins. Similarly, here's Amazon. It looks bullish as well. It gave us a very clean 5-wave advance off of March's low into September's high. Since then, it's been in a counter-trend pullback. This is clearly a counter-trend pullback. Counter-trend pullbacks are more choppy moves. Trendy moves are more direct moves. So we might get a larger pullback. Seems like we should. But once you get a completion of that, it's going to be a good buying opportunity. And that should happen sometime in 2021, according to the pace of things at this point. Here's another one. Baidu. You guys, I'm sure, know this one. Very large Chinese stock. This is on a longer-term basis. You see what's happened off the 2005 low when it was incepted. A very clear 5-wave advance. What happens when 5-wave advance is complete? Price corrects it. So we got a very large correction off the 2014 high. It's been correcting into the 2020 low. Multi-year, 6-year pullback. Lately, it is taking off to the upside. After finding support, largely in the yellow support area, overthrew it a little bit, but here it's turning higher again. This could be the start of a brand new 5-wave advance. This looks bullish. It needs to stay above 157 at all times to remain that way. But if it does, this is going to look like the start of a new 5-wave advance. Looks like a good trading opportunity. Here is Mastercard. We looked at it earlier. Again, it completed a 5-wave advance to the upside, and now it is giving us counter-trend movement to the downside. And it is, after completing a 3-wave pullback, it looks like it's getting strong again to the upside. As long as it stays above 310, this looks promising. I mean, you can't rule out the possibility that you'll get a larger counter-trend pullback, but right now we're playing like it's going to break out and giving us a new 5-wave advance. Either way, you have trendy upside movement and counter-trend downside movement. That paves the way to stronger, higher prices in the future for Mastercard. Here's a look at Michael's companies. All right, off of March's low, it gave us a 5-wave advance to the upside. You know what happens when 5-wave moves complete? It corrects. Here's a 3-wave pullback. Found support right at the top of that yellow support area, and here it goes again to the upside. Looks like this up leg off of November's low is a 5-wave move with a small counter-trend pullback. This looks like the first and second wave of a new 5-wave advance. Michael's needs to stay above, Michael's companies needs to stay above 975 at all times to remain bullish. Nokia, blast from the past, but these guys actually look pretty good. The stock is cheap. Here's what's happened off the 2012 low, so this is a longer-term play. You had a first, second, third, fourth, and fifth wave, a nice 5-wave advance, and then a very large, very time-consuming 3-wave pullback to the downside into the 2020 low. Since then, off of the 2020 low, things have perked up a little bit, and let's zoom in on Nokia to show you why. Here's that advance off the 2020 low, a 1, 2, 3, 4, 5-wave advance, an ABC 3-wave pullback, and now it started off to the upside again. So step back, looks like we could be starting a new 5-wave move like this. You zoom in, you see that upside action is trendy, pullbacks or counter trend moves, looks bullish. Nokia needs to stay above 360 if a low was in. If the low that occurred in October is the end of this pullback and wave 3 has started, overall looks bullish, looks like a good long-term play to me. Here's Nuvasiv, again a longer-term play. You had a big 1, 2, 3, 4, 5-wave advance into the 2017 high, a very volatile but still counter-trend move off that 2017 high, a spike low into the 2020 low. Now you're finding support and seeing this guy turn higher again. As long as it stays above 49, this looks like a pretty interesting buying opportunity, as this could be the start of a new 5-wave advance off that 2020 low. Last one here, this is SPLK Splunk. We looked at it earlier as well. A 1, 2, 3, 4, 5-wave move, a 3-wave pullback that's found support, and now it's turning higher. If the pullback ended in December, it'll stay above 164. That's pretty close. Shoot, it could open up on Monday and be below 164. But if it stays above 164, starts turning higher, this could be the start of a 5-wave advance to the upside. If not, if it's not over yet, you look for the opportunity for it to complete, and then you look to buy it when you start seeing trendy 5-wave moves to the upside. So sorry it was so long. Wanted to cover a lot of things there. That's what happened in 2020. We're on our toes for 2021. We see the potential for a major high to occur, specifically a high to the advance that began way back in 2009. We're not doing a thing. Again, we're bullish. I'm not selling in a market that doesn't know how to go down. I mean, this market seems incapable of going down. So as long as it's going up, I'm hanging out. But the second you see a change in that behavior, I would take it seriously. I mean, at the least, it would mean the advance in 2020 is over, and we're finally going to see some type of correction, which the market has avoided forever. So we need to be careful there. Could be an interesting year. Again, we'll see if the market decides to sync back up with the economy. So, hey, folks, I hope that was helpful. Again, this is Ryan with TrendLizard.com. We look at Elliott Wave analysis on every major market every day of the week. We offer different services, a free trial. Come take a look at us. Come subscribe, and we will provide the path on how to trade the market in all major market sectors every step of the way. Happy New Year. Have a great day. Talk to you next time. Take care.